My name is Josh Ackman and I'm the Portfolio Manager of the River Capital Credit Fund. I'm very pleased to report to you today our 6-monthly performance for the first half of the financial year 2011 to 2012. After a strong performance in risk markets for the first 6 months of the year, the calendar year 2011, the performance in the second half has been somewhat weaker. The landscape's been dominated by the performance in European markets, and we've seen equity markets globally fall by substantial amounts, with European markets down as much as 20%, and even Australian markets somewhat inured from the rest of the world, but still falling by approximately 10%. The risks in Europe have really dominated the landscape for the last 6 months. This has been highlighted by some of the moves in the government bond yields, particularly of Spanish and more so Italian bonds. These have widened to levels that are seen around 6% or even above in the case of Italian bonds. It's important to note with what happened with the Portuguese and Irish governments was before they sought their IMF and ECB rescue packages, their bond yields were also seen around the 7% level for 10 years. So this benchmark level is really a key for the European sovereigns. What we're seeing is that Italian and Spanish levels, particularly the Italian levels, are getting close to this 7% level again for 10-year bonds and have actually exceeded 7% at certain points in time. This really brings into question the sustainability of the debt levels in the European markets and in the bigger sovereigns such as Italy and Spain. Until now, Europe has managed to contain the problem to Portugal, Greece and Ireland. And they can continue to do so because their debt loads are relatively small and Europe is willing to throw large amounts of money in the realm of 400, 500 billion euros or more at this problem. The real key problem and what has really scared markets in the last 6 months is the fact that the Italian and Spanish bond markets and their debt loads are so much larger. In fact, the Italian bond market is perhaps the 3rd or 4th largest bond market in the world and one of the more indebted nations. The reality is that the European Central Bank, the ECB and IMF packages are simply not enough to provide refinancing for the Italian and Spanish bond markets and to refinance their debt loads. So whilst these concerns maintained in the European market, there's been a great deal of volatility and a great deal of uncertainty about how this will play out. We've seen this even more recently with the recent German Bund auction, which performed very badly by historical standards. Typically, bond auctions in Germany and the stronger credits have been oversubscribed by times of 3 up to 5 times oversubscriptions, with maybe 3 billion worth of bonds being tendered for by applications of 6 billion up to 10 billion. We've seen in this circumstance that there was actually a lack of applications for the German bonds, and the Bundesbank was actually required to buy back a substantial amount on their own balance sheet. This really brought into question, again, not only the sustainability of the problems in Italy and Spain, but the sustainability of the European Union as a whole. If investors globally are afraid not only of Italy and Spain, but also of Germany, then this really brings into question how can these markets continue to fund themselves, finance themselves, and how does the European Union hold together? Indeed, just recently, Moody's and S&P have actually started to review the credit ratings of all European sovereigns, not just the peripheral sovereigns, but also of the key sovereigns of Germany and France and others as well. Economic data in the USA and globally has remained somewhat anemic. Recent employment data out of the US has shown some improvement. However, from a global perspective and from an historical perspective as well, the numbers coming out simply are not strong enough to make back a lot of the losses that were created from the period of 2007 through to 2009. So whilst it's encouraging to see some degree of growth and some degree of recovery, the plain and simple facts are that the growth simply has not been enough to make back the losses that were incurred during the GFC. Indeed, even recently, we've seen the markets move back towards the US dollar and a strengthening of the US dollar, which has caused a slight weakening in some commodity prices and the Australian dollar as well. However, even from a longer term perspective, there's no doubt that the US itself has a substantial debt load and has a substantial budget deficit with high unemployment and low growth as well. These are issues that the market will have to face and the US will have to face at a point in time, but for the time being, the problems facing Europe are much more pressing. Australian economic performance has visibly slowed over the last 6 months. As recently as a year ago, the Reserve Bank was still increasing interest rates and now has cut interest rates twice in the last 2 months. We see this continuing in the near term. However, Australian economic performance is still very strong in a relative sense compared to the rest of the world. We've been talking a lot about some of the activities in the rest of the world and from a macro perspective, what's going on globally. But what does this really mean for our portfolio at the River Capital Credit Fund? What it means is that we need to stay very focused and very defensive right now. We're making investments in only the highest quality credits, and we're maintaining a relatively high cash holding with a cash position of about 20 to 25% right now, compared to our usual position of 5 to 10%. However, as mentioned previously, the silver lining to this cloud being that we can now acquire securities issued by the highest quality banks, such as Commonwealth Bank, Rabobank and others, at yields that were not available to us before. And with interest rates falling as well in the market, the relative returns that we are achieving now have actually improved. Whilst previously you would have been aware that you could get term deposits in the realm of 7%, these have now fallen to maybe 5.5%, 6%, yet we're still achieving yields of 10, 11% or above on some of the highest quality issuers. Whilst there's no doubt that volatility in financial markets and concerns over Europe can cause price falls in some of the securities we purchase, even securities issued by the highest quality issuers, we still have the highest degree of confidence that over the medium to long term, we will achieve the returns we're expecting. Recent issuance in the listed hybrid market by Woolworths and ANZ have been hugely oversubscribed and very popular amongst many investors. We thought it was worth taking this opportunity comparing some of the investments we're making to those available in the listed hybrid market. You'll note that on the left-hand side, we see the blue chart showing the yield available on the ANZ PC security, the recent CPS3 issuance. This is currently providing an all-in yield with the benefit of franking credits of 7.34%. Just next to the ANZ is the red bar chart showing the Woolworths security, which was recently oversubscribed by up to 5 times. This is providing an all-in yield to investors right now of only 6.65%, only little above the current term deposit rates. Whilst the green bars on the right-hand side represent the securities that we're able to purchase in the credit fund at the moment and the yields we're achieving on these. It's worth noting that all these graphs, including the listed hybrids and the green ones reflecting the yields we're achieving, are shown net of all fees. So the recent volatility has caused a lot of investors to look for alternatives to term deposits or to equity investments. It's important to remember that the River Capital Credit Fund is not engaging in a trading strategy, but is simply investing in high quality securities issued by the likes of Commonwealth Bank, National Australia Bank, Rabobank and Standard Chartered. So when you buy units in the credit fund, what you're in fact doing is buying a share of these underlying assets. Whilst these securities can rise and fall with the market, we will continue to earn the income stream of around 8 to 12% that we lock in on each investment, and we have confidence that at a set date in the future, we will get our investment back. While some fixed income funds, such as those who track the UBS Composite Index, have benefited lately from the strong rally in government bonds, these such funds are ultimately making a directional bet on interest rates. So these funds will perform well when interest rates fall and perform poorly when interest rates rise. For example, this chart shows us the history of the annual yield available on the Australian government bond with the maturity in May 2021. As recently as April 2011, this bond was providing investors with a return of 5.6% per annum, but from today onwards, this security will only provide investors with a return of 3.73%. So anyone who bought this bond in April has to date achieved a great return. Despite the relatively high levels of volatility we've seen in many asset classes over the last 6 months, we're pleased that in the River Capital Credit Fund, we've managed to preserve investors' capital, as well as continue to generate a high level of income stream for our investors. Indeed, for the 31st of December, we're anticipating a distribution to all investors of around 3 to 4 cents per unit.